Hello, and thank you for joining us. I'm Nick Elliott, Head of Communities at Dow Jones Risk and Research. I'm very pleased to welcome you to this webinar where we're going to be discussing the US-China trade war and the implications for energy. And to do so, we're going to be drawing on our in-house experts from 3 different businesses. We'll be joined shortly by 2 of our experts, one from Dragonfly Intelligence, which puts a security lens on world affairs, and Oxford Analytica, which provides geopolitical analysis. And then later we'll be joined by 2 experts from OPIS. That's our energy pricing and analysis service. We added these businesses into the Dow Jones portfolio not that long ago, with the idea that companies really need a broad view of geopolitical risk, which touches everything these days. So we can now provide you with a full range of types of information, from the broad down to the narrow requirements of your market. We're going to start today by looking at the context for the US-China trade antagonism. And then later on at the end of the program, we'll be dealing with your questions. Don't let me monopolize these experts that I'm going to be interviewing today. Ask your own questions. You can do that on the right-hand side of the platform on the Q&A tag. The more questions you ask, the more room we'll leave for discussing those questions at the end of the program. So now I'm going to introduce our first panel. And we're going to be joined by Barbara Kellerman, head of the Asia desk at Dragonfly Intelligence, and Nick Redman, editor-in-chief and director of analysis at Oxford Analytica. Barbara and Nick, welcome. Thank you so much for joining us. And Nick, if we could start with you, can you give us some of the context for this US-China trade war and China's response to US trade policies?
Thank you, Nick. I think it's important we understand where China's coming from here and where China was at the moment that Donald Trump took office at the start of this year. China was the last major economy to exit the pandemic, and it had very tight restrictions. And that was quite a difficult thing. Not long after that, the property market blew up. That caused problems. In addition, they had problems with high youth unemployment, actually so high at one point they actually stopped reporting it and then revised the measure, brought it back. And then we have these US sanctions. So Joe Biden was maybe expected to ease back some of the Trump first-term sanctions, didn't do so, actually added to them in a much more targeted way, deliberative way, targeting some of those tech sectors that China is really keen to develop. So China is actually in a slightly more difficult position today than it was a few years ago. The authorities radiate a lot of confidence they can actually fix these problems, but what they need crucially is time and a fairly stable external environment. So as Trump came to power, the last thing that China really wants was a tariff war, and yet this is now where they find themselves.
And Nick, how would you characterize China's approach to retaliatory tariffs? Because there's been some commentary about them being fairly careful in the way that they've responded.
Yeah, so if we look at the response to Biden's tariffs, they tended not to be symmetrical. They tended to be maybe less than seeking not to up the ante. It was a difficult calibration to make. On one hand, you don't really want to tax your own consumers, which is what tariffs do. Also want to show that there is something in the arsenal and some resolve, but not show that you're spoiling for a fight, not invite more retaliation or escalation than's the case. So we saw that like a year, 18 months ago. In the last 6 months, the mood music has turned a little bit, and China has moved more into position that it is actually going to stand up and it is going to go toe to toe. Again, it doesn't really want this tariff conflict, but it doesn't intend to be pushed around. It needs to radiate some strength here. And the face is a factor. Don't want to look like you've lost.
Barbara, let's bring you into the conversation now from your vantage point in Singapore and talking to a lot of Asian customers and businesses. Anything that you would add to what Nick has said?
Certainly, thank you, Nick. So I think taking into account what was mentioned, I think one of the important aspects of where China found itself is that they knew the tariffs were coming. President Trump signaled that for a long time during his campaign, even prior to that, and especially people around him. And I think what we saw prior to that was this signaling from the Chinese authorities to its population to prepare for the time of austerity and really prepare for what is going to be an economic pain. So I think that from that vantage point, China has been putting in place potential responses or ways how to address these tariffs for a long time. And I think what we saw here in the region is that China has been trying to really build on these tariffs, expand its influence, reach out to various Asian countries. And similarly, I think Asian countries here have approached these tariffs in a much, I would say, stoic manner. There haven't been that much alarmist narrative, I would say. And in fact, what we are seeing is that the countries in Asia have been kind of the first one to reach out to U.S. administration. And I think that this is kind of showing that the region and China themselves have been anticipating and preparing for this scenario.
And let's turn the conversation now to how things might play out. Nick, there's been a lot of coverage about the Trump administration claiming that China's been in touch to negotiate, the Chinese denying it. I saw there was another report overnight that maybe there have been some conversations. What do you think we might expect over the next few weeks in terms of a possible escalation or de-escalation of this trade war?
Yeah, I think those reports and the conflicting accounts actually shows probably which side has slightly more interest in coming to a deal sooner rather than later. But what counts as negotiation obviously is partly open to some interpretation. I think for China it's quite important that they're not seen to be weak or to fold on a deal. And it's also, I think, important for the Chinese to get a sense of actually what the United States wants. So probably the most disturbing rumor out of the last few weeks in terms of trade negotiations is the sense from the Japanese delegation that left Washington, D.C. empty-handed, that they didn't really have a clear sense of what the United States wants in terms of a trade negotiation. Now, for China, that's going to be critical. There's no way that Xi Jinping is getting on a plane to Saudi Arabia or anywhere else until they have a clear sense what the Americans actually want and whether that's a basis for negotiation that China can work with. And China's got a list of things they'd probably be prepared to do. They are, I think, willing to have a deal ultimately, but it's got to be the right sort of deal. And they're not going to go into something blindly.
What do you think, Barbara? What are the possible ways in which this could play out in the short term?
I certainly agree with the details and the fact that China is not going to agree to any final deal until it's finalized. I think there is the point to make that negotiations about trade deals are always complex, take a long time. There is a lot of back and forth. And I do think that with the current level of tariffs, we are reaching a point where there is going to be significant economic pain imposed on both sides. I would probably go out on a limb and say that we've seen some signs that both sides are kind of changing the narrative. There have been some reports today and yesterday that China has started to take small steps. I don't think they are going to publicly acknowledge that until there is some agreement. But I think that there will need to be some de-escalation, at least for that bigger portion of tariffs that were imposed later. And I think that's something that was previously signaled by some of the widely followed Chinese commentators on social media in China that I think have a credit to some of the statements that they made in the past. So I would suspect that there is going to be some immediate de-escalation, also because the economic impact of tariffs, especially on the US economy, will just become apparent in the coming few weeks when the shortages and all these things will come to play. But then the process will just take a lot of time. And I think similarly to 2018, we're looking at a quite long timeline.
So I know one of the things that you look at Dragonfly, Barbara, is the risks associated with geopolitical events. Is there anything that organizations should be really focused on as the discussions potentially start and as this trade war continues to play out?
Mm-hmm. So I think one of the main concerns have been, potential retaliatory actions by the Chinese side. There is a range of these that we saw in the past. Some of them were, let's say, arbitrary arrests, but I think the more prominent ones right now are investigation into some of the companies. I think that's probably the most concerning aspect, and also potentially for energy sector, but also other, companies that provide services. I think this is something on everyone's mind. And Beijing also signaled that this is one of the things that they could pursue. Now, I don't think this is the route that Beijing wants to take. I would think that no one really wants to see the escalation. The other potential issue are some of those regional conflicts, potential conflicts, such as around Taiwan or such as Brazil. And I think there, again, we are potentially looking at some type of a very limited and controlled escalation or military skirmish, which could disrupt, let's say, flow of trade, maritime trade, especially. But again, I think that this is something that would take probably a few days to play out, but because tensions are so high, it's something that we are monitoring very closely.
And the investigations you mentioned are around a variety of issues, aren't they? I know one of the responses to the first round of tariffs was to announce an antitrust investigation into one of the US tech companies, but I think there are other things that have been done as well. So this is a broad range of risks that companies should be thinking about. Is that right?
Oh yeah. So it's various issues, whether it's copyright infringement, IP theft, all those sorts of things. And I think really, if we look at the past few years, Beijing has been putting in place a really wide-ranging legislation that enables it to target companies specifically on issues that they want to or need to. But again, it's not really in the interest of Beijing to do this in a widespread manner. So I would say that some of these firms have experienced tensions in some of these areas that they are being investigated. I think Beijing has also signaled some of the things that they are looking at, that they are, more scrupulous about. So I suspect that these investigations will be in those areas, such as especially if firms are handling intelligent, sensitive data or data connected to any, critical sectors that China is currently focusing on.
Nick, so we're here to focus on the energy sector in particular. And one thing that caught our attention was China stopping its imports of liquefied natural gas. Does that surprise you at all that market was used in the geopolitical theater? And do you have any broader thoughts about how energy might be affected by the trade war?
So it was an obvious first move. If the United States is going to erect impassably high tariff walls to its own market, then of course China is likely to respond. This comes back to the much more punchy approach that China has adopted in the last few months. And LNG was an easy one. It's completely substitutable. So China can source that from elsewhere. We have colleagues that will come on later. We'll talk more about how easy that is, whether there's any cost differential. But basically, if you get your LNG from Australia, Qatar, or United States, it burns the same. So it's quite an easy one for the Chinese to substitute on. A more interesting one, I think, is the ban on Boeing aircraft, which is being sort of quite rightly reported. That's much more difficult to substitute. And that's an interesting indicator that China is actually prepared to accept pain here in order to get a decent deal at the end.
And it sounds like you're both reasonably optimistic that there are incentives on both sides to de-escalate. But if we do move in the other direction, or at least if this carries on somewhat on the current trajectory of these punishing high levels of tariffs, what could be the potential impact there for energy producers, do you think? Nick, do you have any thoughts about how that might play out?
Well, generally, if you see much reduced trade between China and the United States, you're probably going to see lower consumption in those two economies. That's going to take down global GDP growth, and that's really not going to be good for oil prices. It never is. We can complicate things, but quite simply, there's a reasonable relationship between energy demand, and therefore prices, and global economic activity. So that's the obvious thing coming out of this.
Barbara, any thoughts on that question?
Yeah, completely agree. I would probably just add that I think we are reasonably optimistic about scenario, which is quite bad. And we've already seen, especially in provinces in China that are very dependent on producing coal into manufacturing parts of the rest of China, like those could be badly impacted. And we've already seen some data coming out of there that there could be some type of slowdown happening. And all those knock-on impacts, it's something that, in my view, going to have on the sector.
One of the other things that I want to turn to now is the broader impact on trade patterns, because this, of course, comes against the backdrop of something else going on in the world, which is a breakdown of the global trade order and shifts into different trading blocks and companies considering different supply chains and the like. And the center of that may be US-China, but there are many other aspects to it as well. Can you see any significant shifts in energy trade patterns over the coming months as perhaps companies shift away from this very risky US-China relationship? Nick, do you have any thoughts on that?
So I think there's likely to be a reconfiguration of those trade, if only in terms of if the United States is not selling into China, then others will do that. US LNG will probably find other homes. And that's the big one for me out of this. In terms of global energy trade, I think it's a bit more difficult. We're going to have to wait to see what happens in the shorter term beyond that. But that risk, that specter of lower demand, is going to send a shiver across many energy producers. I was in the Gulf not so long ago. That's certainly something they're quite concerned by.
Barbara, what do you think about that?
Yeah, I think from my side, the interesting things that we've been seeing is China reaching out to Europe a little bit more and trying to see some closer relationship there. I think from my point of view, there are limits to that, and it will probably take some time. But what I think is clear is that both sides are now more open to hedging their options. Similarly, Europe is discussing with India about FTA. So I think this need for hedging is one thing that will drive demand and will drive trade to different parts of the world. Again, I don't think we're necessarily looking at a sudden dramatic shift in the world as we know it, but it is influence that is going to incrementally change some of these relationships.
Nick, if I may, Barbara raises a really interesting point about China-Europe. And if this US-China dispute goes on for an extended period, I think that's what we have to look at very closely. China, as Barbara says, reached out to Europe almost straight away. Let's buddy up. The European response was distinctly cool. The Europeans are worried about massive dumping on their own markets. And the longer that the US-China trade goes on, the bigger that is going to be a concern for them. So that's where the second order effects that we're so concerned about with this trade war, that's where they kick in, and that's the place to look for.
Very interesting. So as we, one of the things that I think a lot of people in the corporate world have been struggling with since the Trump administration came into the office is the pace of change, rapid policy changes, and then sometimes changes to those policies almost immediately. As we look to see how this US-China relationship changes in the coming weeks, what should they be looking for? Is there anything that they can identify that would give them a pointer to how things may become a more stable relationship, or some sort of more permanent picture on how this relationship is going to be? Barbara?
So I would say that we are seeing some of those indicators. For us, one of those indicators was any reports that when China was in town in the US for WHTO meetings, there will be reports that they met with the US authorities. We saw some rumors on that front. Similarly, we are now seeing these rumors on Chinese exception to tariffs and kind of changing narrative. So I think, unfortunately, because there is that neither side really wants to go and say first that we are now moving towards the escalation or better relationship. So we have to look for those, again, as was mentioned, second order consequences. But I think just the absence of any major escalation or another issue that is being blown up again is a good sign.
And what do you think about Nick's previous observation that one of the issues the Chinese have is that they're not actually sure what the US is asking for? Do you consider that a major sticking point?
I do wonder sticking point for what? If we're talking about the final deal, I completely agree with that. I think if we're talking about some type of progress, not necessarily. I do think that to some extent, this shifting of priorities and tactics has been a marked style of Trump's administration, even during the first term. And I don't think it's something that is going to necessarily change. But also, I feel like the president has demonstrated that he has no problem shifting his position if he wants to or if he needs to. So I think that once they're managed to find a way to actually get into talks, they're probably going to find a way to de-escalate at least the highest point of tension where we are right now.
Okay, very good. And I see the questions are rolling in, so that's great. As I said at the beginning of the webinar, we'll get to those at the end. We'll bring all of our experts back on stage. But now we're going to move on to the more specific energy segment of this event. So I'd like to thank Barbara and Nick for their thoughts so far, and we'll come back to you later. And now I'm going to welcome up our next two speakers, James Stevenson and Carlo Barassa, both from OPIS, specialists in their field. So, James, if we could start with you, one of the things that caught our attention was China stopping its purchases of liquefied natural gas. How important is that?
Look, it's a great headline, right? China is the world's biggest importer of LNG, and the United States is the world's biggest exporter of LNG. So it seems like this would be a big deal, and certainly it has hit headlines. The reality is that China imports very little LNG from the United States. It's on, depending whose stats you believe, it's on the order of 4.5 to 5.5 million tons a year out of the 77 million tons that China imports, and out of the 90 something that the United States exports. So China can source, it primarily sources from Australia and then Qatar. It has options, and that is the single thing that will damp the impact of this. Even in the event that there were issues with sourcing LNG from somewhere else, China could run its coal-fired power plants harder. LNG is primarily an electricity generation fuel in China, as well as a few industrial uses. But there's been a big nuclear build-out program in the southeast of China where a lot of this LNG is imported. So it's a headline grabber, but the net impact we think will be relatively small.
And over the longer term, though, could it have more of an impact? Because I think LNG demand is rising at a good clip, isn't it?
It is, and I suppose that's where this potentially could be a bigger deal, although we don't think it will be. First, I doubt this ban would be long-lasting. LNG demand is growing rapidly. It grows 35 million tons a year. We expect that to grow at that rate well past 2030. China will grow from 77 million tons in 2024 to over 100 in that time frame. Even then, though, we just had an announcement last night of a new project in Oman to supply LNG. There's a very solid pipeline of projects. And in fact, in the next couple of years, we think that LNG will be LNG prices will weaken because we have a wave of LNG supply coming into the market. So the next couple of years, LNG should be relatively affordable. And it would only be really if this ban extended, probably into the 2030s that it could matter. But even then, I think China will have abundant other options.
Okay, great. So we shouldn't get overly excited about this good headline that you described. But are there potential impacts on other commodities from this action?
Yeah, look, directionally there are. Again, I think they will be limited. Whenever you get these trade bans or tariffs that effectively close the arbitrage for a trade of a commodity, usually what happens is you get a rearrangement of flows. So maybe China doesn't take that 4 or 5 million from the United States. Instead, it takes it from Qatar or Australia or Papua New Guinea or somewhere. That can have impacts on LNG freight rates. Net of net, usually a ban means that vessels will be sailing further than they would normally, and therefore freight rates can rise a little. I think that'll be a very marginal impact. This would be directionally bullish LNG pricing. Again, I think that's very marginal, but insofar as LNG goes up, that helps the economics of coal dispatch in places like Europe. So it could slightly increase coal burn. Net of net, I don't think this is a big impact, though.
Okay. One last question for you before we turn to Carlo. You caught the earlier discussion with Nick and Barbara. do you have any thoughts about the implications of the trade war for energy, and in particular, whether energy may be at the center of some other trade deals that the US tries to secure around the world?
Yeah, it's a great point. A lot of people made a big deal about this equation that the Trump administration showed when it came to describing how tariffs were arrived at. Ultimately, that equation is saying that if you have if the United States has a negative trade balance with you, you're going to get a high tariff. And so the implication, what we see happening, is that the administration will push trade deals with countries to take more US product. And that might be soybeans, it might be corn, but it might be LNG, it might be US coal, and really any form of US energy. Now, I don't think we're going to see those deals with China for the reasons that the previous two speakers were talking about. But I wouldn't be surprised if we had announcements of a deal like that with Vietnam, other countries in Southeast Asia, countries in Europe, and that kind of thing. I think we will get negotiated trade deals out of the administration, and those will include energy products.
Great, thanks for that. Now, I'd like to welcome Carlo. Thanks for joining us, Carlo. I wanted to ask you about crude oil, because we've seen prices going down. There seems to be some general worries about the impact of the tariff war on the world economy. Does that make sense to you?
It does. So when we look at the supply-demand fundamentals, Nick, things were already on a shaky ground, because we're about 2.5 million barrels of supply growth for this year, probably a similar level of supply growth next year, relative to about 1 million barrels of demand growth this year and next year, right? So, I know I went to the University of Texas, but my math tells me that that's about 1.5 million barrels of oversupply. So really, that's not a good balance for higher prices, right? And so I think when we have a trade war, regardless, tariffs are, I don't think there's an economist in the world that would say tariffs are good for global trade. They're actually bad. And global trade needs to happen to promote growth in the global economy. And so, especially when you have two superpowers, US and China, going at it from a trade war perspective, that's just going to lead to suboptimal growth. Things were already not looking positive from an economic perspective in China. This is just going to exacerbate that growth. And how we look at growth is growth equals higher demand for liquids and oil. And so my assessment is that if the economy begins to deteriorate in an already oversupplied environment, that's when prices will decline. And that's what you're seeing happening in the marketplace right now.
Okay. If we turn to other commodities, so I just discussed LNG with James. He doesn't think the halt to Chinese purchases of US LNG is that big of a deal. But are there other more important commodities in the direct US-China relationship?
I'm glad you asked that, Nick, because OPIS is really the leader in price reporting and analysis on natural gas liquids, as well as petrochemicals. And natural gas liquids tend to be this forgotten byproduct of oil and gas production. But the reality is they're very important to the global economy, not only from a residential and commercial energy perspective, but also from a petrochemical perspective. Ethane, propane, and butane are very critical to the Chinese economy. The United States, over the last 15 years, has boosted their growth as a result of all the hydrocarbon development that has happened. And so when we look at ethane in particular, ethane has grown by leaps and bounds. It has underpinned new petrochemical production here in the United States, but also abroad. We started exporting ethane, at least from a waterborne perspective, in 2016. A lot of that waterborne ethane is currently going to China. And we talked offline in the green room, Nick, that ethane is highly desired as a petrochemical feedstock because it's actually linked to gas as opposed to some of the other petrochemical feedstocks that are more linked to oil. And so what I would say is that since the U.S. is a single supplier to China on ethane, there's a pretty high dependency there. I know there's been a lot of reports in the media that China will waive. I think a lot of these reports stems from a list that was being circulated amongst various firms in China last week, that there was a list of products that were slated for waivers, and ethane was one of them, as well as polyethylene, which is the ultimate product from petrochemical production using ethane as a feedstock. And so really, it's not surprising that there's a lot of rumors that that this is going to be waived, but we tend to be a little bit more conservative, and we want to hear officially from the Chinese government. We'll likely not hear any firm confirmation, but what we hear from our colleagues in China, that ships are still being loaded, cargoes are still being delivered, and so there is a high likelihood that ethane will be waived.
And can you just, for the audience, can you put into context the importance of that China-US trade in propane and ethane and butane? Like what proportion of US product goes to China, roughly?
No, that's a great question, because when we look at the ethane exports, and really if we look at ethane production overall from the United States and then factor in exports, we're looking at around probably a quarter of the production of ethane actually leaves the U.S. shores, and out of that quarter of the production, probably about 60% of it actually goes to China, at least from an ethane perspective. Propane, that's another situation, and I know there's been questions that have been fired off in the Q&A list here, and one of them was specifically about propane. Propane, if you think about the United States, let's say the last time that a trade war erupted between the U.S. and China, 2017, the U.S. was exporting about 850,000 barrels a day of propane. Year to date this year, we're probably 1 million barrels over that, right? And so that's a significant amount of volume that's leaving our shores. And yeah, when you look at a global oil and liquids environment, about 1.5 million, about 100, just a little over 100 million barrels of total oil and liquids. Yeah, it may seem like a drop in the bucket, but really in these smaller commodities such as ethane and propane, they tend to be very big, right? And so the other region that is significant from a propane export perspective is the Middle East and North Africa, right? So when we look at their exports, roughly around a little over 1 million barrels a day, and compare and contrast that to the U.S. alone at about 1.8 million, 1.9 million, that's a significant amount of volume that's making its way into the marketplace. And so when China, having their huge dependency on propane, largely because of their petrochemical sector, propane has more, there are more options, very similar to LNG. But last time, restructuring or reshuffling trade flows at a much smaller base of exports from the United States was a lot easier than it's going to be this time around. The United States has now become a behemoth in the propane export trade. And so the reality is, yeah, you should be able to swap cargoes and make some trade reshuffling. But unfortunately, at that bigger volume of the United States, there'll probably be some barrels that'll be backed up in the United States, which in turn will pressure prices here in the domestic market.
While we're on that theme of the domestic market, and this is a question for either of you, Carlo or James, what about the knock-on effects on U.S. energy investment, especially if we see a longer period of soft crude prices, which Carlo, I think you were saying you expect to endure?
Yeah, I'll let James tackle that first, and then I'll come in.
I mean, the big one, we just had Woodside announce their new project in Louisiana a couple of days ago. That's it's 3 trains, I think 16.5 million tons of LNG a year.
Huge. Yeah,
So,
huge.
you know, the investment environment is solid. Now, if you get weak crude prices, you get less crude production, which means less associated gas production, which means healthier gas prices, and that can incentivize activity in the gas space. I think for investment, you know, one of the things we haven't talked about, LNG is a big electric generation fuel, and we have very strong outlooks for electric power demand, given AI, given data centers, chip plants, electric vehicles. So there really is an investment phase needed. And actually, I was at a conference last week where I was talking to a company that's based in Alabama, and they were saying that for the first time, some of these data centers were getting pushback because of questions around electric availability near that prospective data center site. So we certainly have need for generation in the electric power space, and you know, most other energy needs are growing as well. The big question is what happens with the economy, of course, and that's a big question mark right now.
Yeah, if I could dovetail with what James was saying, Nick, I think there's 2 time horizons, right, in terms of investments. There's the near term and really the long term. And if we look at the near term, James is exactly correct, right? Lower oil prices, you know, isn't conducive to more hydrocarbon development, at least here in the United States. We're still in a cycle, at least with the major producers, of capital discipline. They're not going to grow for growth's sake. They want to do it profitably. And I think that's where, if we see lower oil prices, we'll tend to see slower development and at some point plateauing and maybe even slight declines in oil production. I think this puts the administration in a very tough spot. It's got a dilemma on its hands, right? You want lower oil prices because that's good for the consumers, but at the same time, you want to unleash the strength of American energy out to the global marketplace. And so having oil prices at $50 a barrel, $40 a barrel, that doesn't help anybody, right? At least from a production perspective. And then when we talk about these smaller commodities, NGLs, right? Any little increment on profitability at the well is welcome, especially when under challenged oil prices. And if we see an environment of higher supply of gas globally, this trade war essentially backing up barrels of NGLs into the United States, and then lower oil prices, it's just not conducive for growth. So really, we do need higher prices to motivate development. Now, that being said, from a longer term perspective, I think we completed our long-term annual outlook, and we are actually probably counter to what a lot of our competitors are saying. We're actually closer to the OPEC view of oil demand out into 2050, as opposed to seeing some declines. We're actually seeing some small and modest growth out to 2050. And so when we get to that time period, think about the 100 million barrels that I mentioned earlier. 80% of that volume will need to be replaced. You know, fundamentally, we think that the world is still highly levered to hydrocarbons. And then with the trade war, when you get more polarization, you get less collaboration on climate initiatives, et cetera. And so I think this provides an environment for continued growth, modest growth here in the future of hydrocarbons. And so we'll still need that development out into the future for that to supply that demand growth.
Great. Okay. At this point, I'm going to ask our other 2 speakers to come back to the stage, and we'll start going through some of these many audience questions. So, Nick and Barbara, if you'd like to rejoin us. And I'm going to start with a question from Anne. I'm going to put this to James, but then another version of it I'm going to put to Nick and Barbara. So Anne wants to know, are we aware of any effort by the Chinese government to lobby other countries to reduce US LNG imports? James, is that something you've come across at all? Have you seen any reporting on that?
I have not. I do think we had a bit of talk a little earlier about kind of trade blocks developing, and I think that is something that is happening. I'm not aware of the Chinese government directly lobbying with regards to LNG or oil.
So the version of it I want to put to Barbara and Nick is, we may not know of a specific example here of the Chinese lobbying on this issue, but is it the kind of thing that China would conceivably do? I know there's been coverage of their broad diplomatic outreach, but would they get involved in actually trying to strong arm other countries into not taking US products? Nick, do you have thoughts on that?
No, I'd be very surprised if they did that, but it's conceivable, I think, that there might be pressure on Chinese companies operating in third countries to be careful about US products. So indirectly, yes, but it's not really in the Chinese playbook to do that. This is more of a Trump administration approach to trade, where actually you try to corral third countries into following your trade policies.
Barbara, any additional thoughts on that question?
I do agree. Unlikely they will do it directly. We saw reports that they've been delaying some of the shipments in light of the announcement that Apple will move the supply chain to India. So that's more in line with type of things they're trying to do. But there is a pattern with China-allied countries to follow their pattern, whether it is in terms of recognition, especially in regards to Taiwan, or other actions. So if things deteriorate, I could see something like that happening.
Okay, we'll take the next question from Peter, and this one I think is probably for you, Nick. It's just really a geopolitical question. So the US runs an overall services surplus, which helps to mitigate its goods trade deficit. How does this apply in the US-China context? Obviously China's been buying US debt for a long time at the same time as exporting lots of goods. You would think maybe that would figure in the relationship somehow, wouldn't you?
Yeah, but the services surplus is quite small compared to the goods trade deficit. It matters somewhat, as James alluded to, because the Trump administration's calculations were based on goods trade rather than services within the mix. But it's difficult to see how that is much of a card for China. Although if you think about what a big deal might look like, it could well involve something on the services side of it as well. Perhaps Chinese promises to buy more US service goods as part of an overall deal. We saw something not hugely dissimilar to that back in sort of 2018, 2019 with the phase one deal.
Carlo, I'm going to put this question to you. This comes from Henry. It's asking about how Russia fits into this global oil picture. Given Russia's economy isn't faring too well, could lower energy prices have a positive impact by increasing Russia's willingness to come to the negotiating table regarding Ukraine?
That's an interesting one, right? Because Russia has been able to weather lower oil prices in the past through using their shadow fleet to be able to deliver oil to various countries that are willing to buy it. But now we're kind of stuck in a broader fundamental downturn in terms of oil prices because of the supply-demand imbalance. And directionally, one would think yes, but there are probably ways for the Russians to be able to make their products appear in the global marketplace. So yes, I want to say yes, but still don't count out the ingenuity of being able to weather the storm.
And we have a related question here from Gilliana asking whether the US-China trade war could have a positive impact on Russia. Nick, do you have a view on that?
Positive impact on Russia? Well, it would be quite good for the Russians if they could export more to China. They're running quite a large deficit with them, but they're interested, for instance, in whether they can actually develop more soybean production in Russian Far East, and that would go into the Chinese market, although it'd be more Brazil or other Latin America producers that would suffer that one. If I can actually just come back to the earlier question on whether lower oil prices bring Russia to the table, almost certainly no. Russia has for many years operated quite a large rainy day fund. Putin, for all of his political quirks, always put technocratic, competent people in charge of the economic portfolios. So Russia has good fiscal buffers. The economy certainly is in some trouble right now. Inflation's quite high. The labor market's very tight. Food price inflation is quite high. But look at the budget deficit for this year. Projections, actually, it's really going to be quite small. And GDP growth still reasonable. So I wouldn't give in to the idea that a few months of low oil prices is really going to harm Russia or change its approach to the Ukrainian conflict.
Yeah, not a few months, but a few years, right? A few years, that's a different story, right?
And everyone else has to remain in the conflict for that long too.
Yeah, exactly.
Now we have a question from Ron about OPEC. Carlo, I'll put this one to you. Is OPEC policy being influenced, or is their production increase being accelerated by as an anti-US production tactic? Do you think that comes into play at all? Does OPEC shape its policy based on partially on what the US is doing?
I mean, look, if you take OPEC, the broader nations, in the one entity, the one country that's driving OPEC, Saudi Arabia, if you take them at their word, they are trying to balance supply demand. I don't think any OPEC nation wants to see lower oil prices. They could probably weather it for a short period of time, but really we're stuck in this oversupply environment, right? OPEC knows this, right? And right now, what they're trying to do is they're trying to walk a fine balance between looking at all the outages that typically happen in a given year, as well as the impacts of sanctions on Iran, and trying to essentially balance that out. Now, we have seen some bad actors within OPEC try to increase production, and surely Saudi Arabia could open the spigots and unleash more production, lower oil prices, just to bring the other OPEC members to heel. But really, they are trying to balance supply demand. No one wants lower oil prices for a sustained period of time, and I think that's really where their heads are at.
I'm going to put this question to you, James, because it concerns Australia, your native country. So China and Australia had a trade war for a couple of years recently. Are there any takeaways from that which would give us insight into the US-China trade war?
Yeah, that's a great question. China effectively banned a number of Australian commodities. Coal was the big one, but wine and lobsters, I recall, and then half a dozen other smaller commodities. And I remember colleagues in Singapore enjoying cheap Australian wine for a few years because the Australian growers had to push it into other markets, which is what happens when there's a trade war. A couple of comments, very telling. In that trade war, there was no inclusion of iron ore and there was no inclusion of LNG. And I think China knew had it included those, it would have been very painful. Ironically, what happened was that coal prices soared, both for coal for electricity production and coal for steelmaking. And it made Australian coal miners very profitable. It made coal miners around the world very, very profitable. And it meant that Chinese utilities, even though they weren't buying from Australia, they were buying from other places and they were paying higher prices. So it backfired in a sense, although it did give China a great education in how to deal with different qualities of coal. And it also pushed domestic production. So there was and that remains very strong to this day and is a hedge against things like a ban on LNG imports. So the last thing I'd say on that is these things are not necessarily easy to predict. I don't think the Chinese government got the outcomes it was aiming for, but ironically, it also got some benefits that it wasn't expecting to.
Great. Well, I think we're going to wrap it up there. So I'd like to thank Barbara and Carlo and Nick and James for joining us and sharing their expertise and answering the audience questions. Thanks to all of you for joining us today. We'll be doing more of these quickly put together webinars where we draw on the in-house expertise of our portfolio of businesses. So we hope to see you at more of those. Thanks for joining us, and hopefully we'll see you again soon.
Thanks, Nick.
Thanks,
everyone.
Bye.
Thank you.